Section 2.1 to 2.3 Fundamental Analysis. 2.1 Balance Sheet Analysis. A balance sheet is one of the financial statements that provides a snapshot of a company's financial position at a specific point in time. It presents the company's assets, liabilities, and shareholders' equity, allowing investors and analysts to assess its financial health and capital structure. Here are the main components of a balance sheet. Assets. Current assets. These are assets that are expected to be converted into cash or used up within 1 year or the normal operating cycle of the business, whichever is longer. Examples include cash and cash equivalents, physical cash, bank account balances, and highly liquid investments. Accounts receivable. Amounts owed to the company by customers for sales made on credit. Inventory. Goods held for sale or raw materials used in the production process. Prepaid expenses. Payments made in advance for goods or services that will be consumed in the future. B. Non-current assets. These are assets that are expected to provide economic benefits for more than 1 year. Examples include property, plant, and equipment, land, buildings, machinery, and other fixed assets used in the company's operations. Intangible assets, patents, copyrights, trademarks, brand names, and other non-physical assets with value. Investments. Long-term investments in stocks, bonds, or other companies. Goodwill. The excess of the purchase price over the fair value of net identifiable assets acquired in a business combination. Other assets. Miscellaneous assets that do not fall into the other categories, such as long-term prepaid expenses. Liabilities. A. Current liabilities. These are obligations that are expected to be settled within 1 year or the normal operating cycle of the business, whichever is longer. Examples include accounts payable, amounts owed by the company to suppliers and vendors for goods and services received. Short-term borrowings, current portion of long-term debt and other short-term loans. Accrued expenses, expenses that have been incurred but not yet paid, such as salaries, taxes, and utilities. Deferred revenue, payments received in advance for goods or services that will be delivered in the future. B. Non-current liabilities. These are obligations that are due beyond 1 year. Examples include long-term debt, borrowings and financial obligations with a maturity date beyond 1 year. Lease obligations, long-term lease agreements for property or equipment. Pension liabilities, obligations for employee pension plans. Deferred tax liabilities, taxes that will be payable in future periods due to temporary differences between accounting and tax rules. Other long-term liabilities, other non-current obligations that do not fall into the other categories. Shareholders' equity, share capital, the total value of shares issued by the company, additional paid-in capital, amounts received from shareholders in excess of the par value of shares issued. Retained earnings, accumulated profits or losses retained in the company after dividends have been paid. Treasury stock, shares of the company's own stock that have been repurchased and are held by the company. Accumulated other comprehensive income, changes in equity arising from items such as foreign currency translation adjustments, gains or losses on investments, and changes in the fair value of certain financial instruments. The balance sheet follows the fundamental accounting equation: assets equals liabilities shareholders' equity. This equation ensures that the total value of a company's assets is equal to the sum of its liabilities and shareholders' equity, reflecting the company's financing and ownership structure. By analyzing the components of a balance sheet, investors and analysts can assess a company's liquidity, solvency, capital structure, and the composition of its assets and liabilities. It provides insights into the company's financial position and helps evaluate its ability to meet its financial obligations and support future growth. Assessing a company's financial position, liquidity, and solvency is crucial in fundamental analysis to evaluate its ability to meet its financial obligations and sustain its operations. Here are some key factors and ratios used to assess these aspects: financial position, total assets. Review the total value of the company's assets to understand its size and resource base. Total liabilities. Assess the company's total debt and other financial obligations. Shareholders' equity. Evaluate the portion of the company's assets financed by shareholders, which reflects its net worth or book value. Debt-to-equity ratio. This ratio compares the company's total debt to its shareholders' equity, providing insight into its capital structure and leverage. A high debt-to-equity ratio indicates a higher reliance on debt financing, which can increase financial risk. Liquidity. Current ratio. This ratio compares the company's current assets to its current liabilities and measures its short-term liquidity. A ratio above 1 indicates the company has sufficient current assets to cover its current liabilities. Quick ratio, or acid test ratio. Similar to the current ratio, the quick ratio excludes inventory from current assets as it may not be easily converted to cash. It provides a more conservative measure of liquidity. Cash ratio. This ratio assesses the company's ability to cover its short-term obligations with its cash and cash equivalents alone. A higher cash ratio indicates stronger liquidity. Solvency. Debt ratio. This ratio compares the company's total debt to its total assets and indicates the proportion of assets financed by debt. A higher debt ratio suggests higher financial risk and lower solvency. Interest coverage ratio. This ratio measures the company's ability to cover its interest expenses with its earnings before interest and taxes, EBIT. A higher interest coverage ratio indicates a greater ability to meet interest obligations and suggests lower solvency risk. Debt service coverage ratio. This ratio assesses the company's ability to meet its debt obligations by comparing its cash flow available for debt service to its debt payments. A higher ratio indicates a lower risk of default. Working capital. Calculate the company's working capital, which is the difference between current assets and current liabilities. Positive working capital indicates a company has sufficient short-term assets to cover its short-term obligations. Cash flow. Evaluate the company's cash flow from operating activities to assess its ability to generate cash internally and fund its operations. Positive cash flow indicates a healthier financial position. Financial ratios. Assess a range of financial ratios, including profitability ratios, such as net profit margin and return on equity, to understand the company's financial performance and efficiency. It's important to compare these ratios with industry benchmarks, historical trends, and peers' performance to gain a meaningful perspective on a company's financial position. Liquidity and solvency. Additionally, qualitative factors such as the company's business model, market conditions, competitive landscape, and management strategies should also be considered in the overall assessment. Ratio analysis is a valuable tool in fundamental analysis that helps assess a company's financial performance, profitability, liquidity, solvency, and efficiency. Here are explanations of some commonly used ratios, including the current ratio and debt-to-equity ratio. Current ratio. Formula. Current ratio equals current assets/current liabilities. Purpose. The current ratio measures a company's ability to cover its short-term liabilities with its short-term assets. It provides an indication of the company's liquidity and ability to meet its immediate obligations. A ratio above 1 indicates that the company has sufficient current assets to cover its current liabilities. Debt-to-equity ratio. Formula. Debt-to-equity ratio equals total debt/shareholders' equity. Purpose. The debt-to-equity ratio assesses a company's capital structure and leverage by comparing its total debt to its shareholders' equity. It indicates the proportion of assets financed by debt and the level of financial risk. A higher debt-to-equity ratio suggests a higher degree of leverage and financial risk. Gross profit margin. Formula. Gross profit margin equals revenue, cost of goods sold/revenue. Purpose. The gross profit margin measures the percentage of revenue that remains after deducting the direct cost of producing goods or services. It reflects a company's ability to generate profit from its core operations. A higher gross profit margin indicates better efficiency in managing production costs. Net profit margin. Formula. Net profit margin equals net income/revenue. Purpose. The net profit margin represents the percentage of revenue that remains as net profit after deducting all expenses, including taxes and interest. It measures a company's overall profitability and efficiency in managing its costs and expenses. A higher net profit margin indicates better profitability. Return on assets, ROA. Formula. ROA equals net income/total assets. Purpose. ROA measures the company's profitability relative to its total assets. It shows how effectively a company generates profit from its assets. A higher ROA indicates better asset utilization and profitability. Return on equity, ROE. Formula. ROE equals net income/shareholders' equity. Purpose. ROE measures the return earned by shareholders on their investment in the company. It indicates how effectively a company utilizes shareholders' equity to generate profit. A higher ROE suggests better profitability and efficiency in utilizing shareholder capital. Inventory turnover ratio, formula, inventory turnover ratio equals cost of goods sold / average inventory. Purpose: the inventory turnover ratio measures how efficiently a company manages its inventory. It indicates how quickly inventory is sold and replaced within a given period. A higher ratio suggests better inventory management and sales efficiency. These are just a few examples of ratios used in fundamental analysis. Each ratio provides unique insights into different aspects of a company's financial performance. It's important to consider industry benchmarks, historical trends, and the company's specific circumstances when interpreting these ratios and comparing them to peers in order to make informed investment decisions. 2.2 Income statement analysis, evaluating a company's revenue, expenses, and profitability is essential in understanding its financial performance and assessing its overall profitability. Here are key considerations and metrics used to analyze these aspects. Revenue analysis, revenue growth. Assess the company's revenue growth rate over multiple periods to determine its ability to increase sales. Look for consistent or accelerating revenue growth as a positive sign. Revenue mix. Analyze the composition of the company's revenue sources to understand the contributions of different products, services, or customer segments to overall revenue. Identify any dependencies or risks associated with specific revenue streams. Expense analysis, cost of goods sold, COGS. Evaluate the cost of producing or acquiring goods or services that are directly tied to generating revenue. Monitor COGS trends to identify any significant changes in production costs, raw material prices, or outsourcing expenses. Operating expenses. Review operating expenses, such as sales and marketing expenses, research and development costs, and general and administrative expenses. Assess whether these expenses are increasing at a sustainable rate and if they are in line with industry benchmarks. Cost efficiency. Analyze the company's ability to control costs and improve operational efficiency. Compare expense ratios to industry peers and historical trends to identify areas of strength or weakness. Profitability analysis. Gross profit margin. Calculate the gross profit margin by subtracting the cost of goods sold from revenue and dividing it by revenue. A higher gross profit margin indicates better profitability on each unit of sale. Operating profit margin. Calculate the operating profit margin by dividing operating income by revenue. It represents the percentage of revenue that remains after deducting all operating expenses. A higher operating profit margin indicates better operational efficiency. Net profit margin. Calculate the net profit margin by dividing net income by revenue. It measures the percentage of revenue that remains as net profit after deducting all expenses, including taxes and interest. A higher net profit margin indicates better overall profitability. Return on assets, ROA. Evaluate how effectively the company utilizes its assets to generate profit by calculating ROA, which is the ratio of net income to total assets. A higher ROA indicates better profitability relative to its asset base. Return on equity, ROE. Assess the return earned by shareholders on their investment in the company by calculating ROE, which is the ratio of net income to shareholders' equity. A higher ROE suggests better profitability and efficiency in utilizing shareholder capital. It's important to consider these metrics in conjunction with industry benchmarks, historical trends, and qualitative factors such as market conditions and competitive dynamics to gain a comprehensive understanding of a company's revenue, expenses, and profitability. Additionally, comparing these metrics with peers in the same industry can provide valuable insights into the company's performance relative to its competitors. Key income statement ratios, such as gross margin, operating margin, and net profit margin, provide insights into a company's profitability and efficiency. Here's an overview of these ratios. Gross margin, formula. Gross margin equals revenue, cost of goods sold, / revenue. Purpose. The gross margin measures the profitability of a company's core operations by indicating the percentage of revenue that remains after deducting the direct costs associated with producing or acquiring goods or services. A higher gross margin suggests better pricing power, cost control, and efficiency in managing production or procurement costs. Operating margin, formula. Operating margin equals operating income / revenue. Purpose. The operating margin reveals the profitability of a company's core operations, taking into account both the direct costs of goods sold and operating expenses, such as sales and marketing expenses, research and development costs, and general and administrative expenses. It indicates the percentage of revenue remaining after deducting all operating expenses. A higher operating margin indicates better operational efficiency and cost management. Net profit margin, formula. Net profit margin equals net income/revenue. Purpose: the net profit margin measures the overall profitability of a company, including all expenses such as taxes, interest, and non-operating items. It indicates the percentage of revenue that remains as net profit after deducting all expenses. The net profit margin reflects the company's ability to generate profit from its revenue. A higher net profit margin indicates better overall profitability and effective management of costs and expenses. These ratios are expressed as percentages, allowing for easy comparison across different companies, industries, and time periods. It's important to note that the interpretation of these ratios can vary based on industry dynamics and the company's specific circumstances. Comparing these ratios with industry benchmarks and historical trends, as well as analyzing them in conjunction with other financial metrics, can provide a more comprehensive understanding of a company's profitability and efficiency. Assessing a company's earnings growth and quality is important in evaluating its financial performance and sustainability. Here are key considerations and metrics used to analyze these aspects: earnings growth, year-over-year growth. Compare a company's earnings from one period to the same period in the previous year to assess its year-over-year earnings growth. Positive and consistent growth is generally viewed positively. Compound annual growth rate, CAGR. Calculate the CAGR of earnings over a specific period to understand the average annual growth rate. This provides a more comprehensive view of earnings growth over time. Quality of earnings, revenue source analysis. Evaluate the sources of a company's revenue growth. Assess whether the growth is driven by sustainable factors such as increasing market share, expanding product lines, or entering new markets, rather than one-time events or non-recurring factors. Earning stability. Analyze the consistency and stability of a company's earnings over time. Evaluate if earnings are volatile or subject to significant fluctuations, as this could indicate risk or low earnings quality. Cash flow analysis. Examine the company's cash flow from operating activities to validate the quality of reported earnings. A company with strong and consistent cash flow generation is generally considered to have higher quality earnings. Accounting practices. Review the company's accounting policies and practices to ensure they are in line with industry standards and regulations. Evaluate if there are any unusual or aggressive accounting practices that could impact the quality of reported earnings. Earnings per share, EPS growth. Assess the growth in EPS over time to determine the company's ability to generate earnings on a per-share basis. Positive and consistent EPS growth is generally seen as a positive indicator. Diluted EPS. Consider the impact of potential dilution on EPS by examining the diluted EPS figure. Dilution can occur from stock options, convertible securities, or other potential sources. Return on equity, ROE. Evaluate the company's ROE, which measures the return generated on shareholders' equity. A consistently high ROE suggests the company effectively utilizes shareholder capital to generate earnings. Analyst forecasts. Review analyst estimates and consensus forecasts for future earnings growth. This provides insights into market expectations and can help assess the company's growth prospects. Industry and peer comparison. Compare the company's earnings growth and quality metrics with industry peers to gain perspective on its relative performance. Consider factors such as industry trends, competitive dynamics, and the company's market position. It's important to consider these metrics in conjunction with other financial and non-financial factors when assessing a company's earnings growth and quality. Additionally, analyzing historical trends, management guidance, and the overall economic and industry environment can provide a more comprehensive evaluation of a company's financial performance and prospects. 2.3 Cash flow statement analysis. Analyzing a company's cash flows from operating, investing, and financing activities is crucial to understanding its financial health, cash flow generation, and capital allocation. Here's an overview of these cash flow categories and their analysis. Cash flows from operating activities. Definition: Cash flows from operating activities represent the cash generated or used in a company's core operations, including revenue generation, production costs, operating expenses, and working capital changes. Analysis. Positive cash flow. A positive cash flow from operating activities indicates that the company's core operations are generating sufficient cash to fund its ongoing activities. Consistency and trends. Analyze the trend and consistency of operating cash flow over time to assess the company's ability to generate consistent cash flow from its core operations. Cash flow margin. Calculate the cash flow margin by dividing cash flow from operating activities by revenue. This metric indicates the percentage of revenue converted into operating cash flow and reflects the efficiency of the company's operations. Cash flows from investing activities. Definition. Cash flows from investing activities reflect the cash used for or generated from investing activities such as the purchase or sale of long-term assets, investments, and acquisitions. Analysis. Capital expenditures. Assess the level of capital expenditures and evaluate if the company is investing in growth opportunities or maintaining its existing assets. Asset dispositions. Analyze any cash inflows from the sale of assets and determine if the company is divesting non-core or underperforming assets. Strategic investments. Evaluate any cash outflows related to acquisitions or investments in other companies and assess their potential impact on the company's growth and profitability. Cash flows from financing activities. Definition. Cash flows from financing activities represent the cash generated from or used in raising capital and fulfilling financing obligations, such as issuing or repurchasing equity or debt, payment of dividends, and repayment of loans. Analysis. Debt financing. Evaluate the company's debt issuance and repayment activities to assess its borrowing needs. Repayment capabilities and debt structure. Equity financing. Analyze any equity issuances or repurchases to determine if the company is raising capital or returning value to shareholders. Dividends. Assess the cash paid as dividends to shareholders and evaluate the company's dividend policy and its impact on cash flows. By analyzing these three categories of cash flows, you can gain insights into the company's ability to generate cash, its investment and expansion strategies, its financing activities, and its overall financial health. It's important to consider these cash flows in conjunction with other financial statements and metrics to get a comprehensive view of the company's cash flow position and its ability to fund operations. Invest in growth and meet financing obligations. Cash flow ratios provide insights into a company's cash flow generation, liquidity, and ability to meet its financial obligations. Here are some key cash flow ratios. Cash flow from operations to net income ratio. Formula. Cash flow from operations to net income ratio equals cash flow from operations / net income. Purpose. This ratio compares the cash flow from operations to the net income reported on the income statement. It helps assess the quality of reported earnings and the cash flow conversion efficiency. A ratio significantly higher than 1 suggests strong cash flow generation relative to net income. Free cash flow. Formula. Free cash flow equals cash flow from operations, capital expenditures. Purpose. Free cash flow represents the cash generated by the company's operations that is available for distribution to investors, debt repayment, or reinvestment in the business. It provides an indication of the company's ability to generate cash after meeting its capital expenditure requirements. Operating cash flow ratio. Formula. Operating cash flow ratio equals cash flow from operations / current liabilities. Purpose. This ratio evaluates the company's ability to cover its short-term liabilities with its cash flow from operations. It indicates the company's liquidity and its ability to meet its immediate obligations using internally generated cash flow to debt ratio. Formula. Cash flow to debt ratio equals cash flow from operations / total debt. Purpose. This ratio measures the company's ability to generate sufficient cash flow from operations to cover its total debt obligations. It provides insights into the company's solvency and its ability to service its debt. Cash flow margin. Formula. Cash flow margin equals cash flow from operations / revenue. Purpose. The cash flow margin measures the percentage of revenue that is converted into cash flow from operations. It indicates the company's efficiency in generating cash flow from its revenue. Cash conversion cycle. Formula. Cash conversion cycle equals days inventory outstanding, days sales outstanding, days payable outstanding. Purpose: the cash conversion cycle evaluates the efficiency of a company's working capital management by measuring the time it takes to convert inventory and receivables into cash, minus the time it takes to pay its suppliers. A shorter cash conversion cycle indicates better management of working capital and faster cash flow generation. These cash flow ratios provide valuable insights into a company's cash flow generation, liquidity, and ability to meet financial obligations. They can help investors and analysts assess the company's financial health, cash flow efficiency, and its capacity to fund operations, investments, and debt repayments. It's important to consider these ratios in conjunction with other financial metrics and analysis to gain a comprehensive understanding of the company's cash flow position. Assessing a company's cash flow generation and financial flexibility is crucial in understanding its ability to fund operations, invest in growth opportunities, meet financial obligations, and navigate unexpected events. Here are key considerations and metrics used to evaluate these aspects. Cash flow from operations: analyze the trend and consistency of cash flow from operations over multiple periods to assess the company's ability to generate cash from its core operations. Compare the cash flow from operations to net income to evaluate the quality of reported earnings and the conversion of profits into cash. Consider the company's cash flow margin, which measures the percentage of revenue converted into cash flow from operations. A higher cash flow margin indicates better cash flow generation efficiency. Free cash flow, FCF, assess the company's ability to generate free cash flow, which represents the cash remaining after meeting capital expenditure requirements. Analyze the trend and magnitude of free cash flow over time to understand the company's capacity for internal funding, dividend payments, debt reduction, and investment in growth opportunities. Compare the company's free cash flow to its net income to assess the extent to which profits are translating into cash flow coverage ratios, interest coverage ratio. Evaluate the company's ability to cover interest expenses by dividing its operating cash flow by its interest expenses. A higher ratio indicates greater financial flexibility and ability to meet interest obligations. Debt service coverage ratio: assess the company's ability to cover its debt service requirements by dividing its operating cash flow by its total debt service obligations, including principal and interest payments. A higher ratio suggests better financial flexibility and ability to meet debt obligations. Liquidity ratios: current ratio: evaluate the company's short-term liquidity by dividing its current assets by its current liabilities. A higher current ratio indicates better liquidity and the ability to cover short-term obligations. Quick ratio: assess the company's immediate liquidity by dividing its quick assets, current assets excluding inventory, by its current liabilities. The quick ratio provides a more conservative measure of liquidity, as it excludes inventory that may not be easily converted into cash. Capital structure and debt levels: analyze the company's capital structure and debt levels to assess its financial flexibility. Excessive debt levels may hinder cash flow generation, increase interest expenses, and limit investment opportunities. Consider metrics such as the debt-to-equity ratio and leverage ratios to evaluate the company's debt burden and financial risk. Cash reserves and working capital management: evaluate the company's cash reserves and working capital management practices. Sufficient cash reserves provide a buffer for unexpected events. While effective working capital management ensures the efficient utilization of resources, it's important to consider these metrics in conjunction with industry benchmarks, historical trends, and qualitative factors such as market conditions and competitive dynamics. Additionally, understanding the company's business model, growth prospects, and risk factors can provide insights into its cash flow generation and financial flexibility.